All right, so the Bank of Canada just slammed on the brakes and slashed interest rates. And everyone is trying to figure out, like, if this is a pit stop or like a full-blown U-turn.
Right.
We've got intel from the bank itself, financial gurus at NerdWallet and Money.ca, and even down in the mortgage trenches with Nesto.ca.
Okay.
Our mission today is to decode what this rate cut really means for your wallet.
Interesting, because it's not just a tap on the brakes.
Okay.
The Bank of Canada is practically doing donuts in the policy parking lot by ending quantitative tightening.
Whoa, okay. Donuts.
Yeah.
I like where this is going.
Yeah.
So the headlines are blaring about a 25 basis point drop, putting the overnight rate at 3%.
Right.
But there's more to it than meets the eye.
Definitely.
Okay.
Remember how the bank was shrinking its balance sheet, trying to cool things down?
Yeah.
That's out the window.
Oh, wow.
They're switching gears, and we'll be buying assets again come March.
Hold up, buying assets.
Yeah.
Wouldn't that pump more money into the system?
Exactly.
When they were trying to reduce it before?
It's a bold move.
Okay.
And it suggests they're seriously worried about some storm clouds on the economic horizon.
Oh.
One of the big ones is the U.S. threatening trade tariffs.
Right.
Remember, we're pretty reliant on our neighbors down south.
Yeah.
And Money.ca is saying those tariffs could trigger a domino effect, shaking up the bond market and ultimately pushing up fixed mortgage rates.
Yeah, Money.ca painted a pretty vivid picture of that, didn't they? It's like one of those chain reaction machines.
Right.
Except instead of marbles, we're talking about billions of dollars?
And it's not just the U.S. factor.
Okay.
The Bank of Canada is also looking inward.
Right.
Their own monetary policy report is basically flashing warning signs about weak business investment here at home, job growth that's lagging, and the impact of reduced immigration on our long-term economic potential.
So it's like they're hitting the gas, buying assets, while also easing off the brakes, cutting rates, trying to find that sweet spot where the economic engine hums but doesn't overheat. But some of our sources weren't exactly cheering from the sidelines, right?
Right.
They pointed out some potential downsides to this strategy.
There's always a catch.
Okay.
Nesto.ca used this phrase, payment shock.
Oh.
Not exactly the kind of surprise you want when checking your bank balance.
Payment shock.
Yeah.
Okay, that sounds a bit ominous.
Yeah.
Can you unpack that a little?
Imagine a bunch of people happily cruising along in their cars.
Okay.
Enjoying those super low pandemic-era interest rates on their mortgages.
Right.
Suddenly, the Bank of Canada jacked up the speed limit.
Meaning?
Meaning interest rates rise.
Okay.
Those with variable rate mortgages, or even those coming up for renewal, are suddenly slamming on the brakes, facing way higher monthly payments.
Ouch. Yeah, that's a fender bender, for sure, especially if you weren't prepared.
Right.
So for someone caught in this interest rate traffic jam, what's the best route to take?
That's the million-dollar question.
Fixed or variable rate mortgage?
Money.case did a good job laying out the map for us.
Okay.
Variable rates usually start you off in the fast lane, lower payments.
Okay.
But they can change with the Bank of Canada's whims.
Right.
So you might hit some unexpected detours.
Like construction.
Fixed rates are like staying on the scenic route.
Okay.
Predictable, stable payments.
Yeah.
But you might miss out on those potential savings if rates take a nosedive.
So it's like choosing between a sports car and a reliable SUV. Both have their pros and cons depending on your driving style, right?
It boils down to how much risk you're comfortable with.
Right.
Can you handle the possibility of your payments accelerating?
Yeah.
Or do you prefer the steady, predictable cruise control of a fixed rate, even if it might cost you a bit more in the long run?
And it's not even as simple as just those two options anymore, right?
Right.
I mean, Nesto.ca brought up VRMs, variable rate mortgages with fixed payments, and ARMs, adjustable rate mortgages. It's like now we have to choose between a manual or automatic transmission too.
Exactly. With VRMs, you have the same monthly payment.
Okay.
But the amount going towards interest can fluctuate.
So you could.
So you might be driving further than you thought to pay off that loan.
I see.
With ARMs, your payment fluctuates directly with the interest rate.
Uh-oh.
So buckle up for a potentially bumpy ride.
Okay.
The choice between them depends on how much control you want over your payments.
Right.
And how much risk you can stomach.
So we've got a lot to consider. The economic landscape, interest rate shifts, and different types of mortgages. Before we get completely lost in this financial maze, what's the best way to navigate all this?
First, take a deep breath.
Okay.
Don't panic.
Okay.
We're going to figure this out together.
All right, deep breaths taken.
Okay.
But what's the next step on this roadmap?
Get to know your financial terrain.
Okay.
What are your goals? Your risk tolerance? Your income and expenses?
Right.
Once you have a clear picture of that, it's time to compare interest rate offers from different lenders.
Yeah.
Think of it like shopping for the best gas prices.
Right.
You wouldn't just fill up at the first station you see, would you?
Definitely not. You got to check those gas price apps.
Right.
See who's got the best deal.
Exactly.
So we're talking about comparing rates from the big banks, smaller institutions, maybe even checking in with a mortgage broker.
Exactly.
They're like the ultimate gas price guru, right?
And keep your eyes on the Bank of Canada's announcements.
Right.
They're like the traffic reports for the economic highway.
Right.
They can give you clues about where interest rates are heading.
So know yourself. Compare rates. And watch for those Bank of Canada signals?
Exactly.
Now, our sources dug up some pretty interesting details about mortgages. Like the fact that there are special rates for insured mortgages.
Right.
And the lowest rates often go to those with more than 10% down, but less than 20%.
Right.
It's like a secret menu at a restaurant.
I gotta know the code words.
That's because of something called default insurance.
Okay.
Which lenders use to protect themselves in case a borrower can't repay their mortgage.
Makes sense.
It's a cost that's baked into your rate. And the amount of down payment you have affects how much risk the lender is taking on.
So those with a bigger down payment are seen as less risky.
Right.
And that translates to lower rates.
Exactly.
It's like getting a discount for being a safe driver.
And speaking of interesting details.
Okay.
Did you know TD Bank marches to the beat of its own drum?
Wait, really?
With its own prime mortgage rate? So they're not directly tied to the Bank of Canada's prime rate. What's the deal with that?
That's a great question.
Why would they go rogue like that?
It's one of those quirks of the market.
Okay.
And it highlights why comparing offers from different lenders is so important.
Right.
You never know what you might find.
It's like they're playing a different game altogether.
Yeah.
All right, so we've covered a lot of ground here.
We have.
But before we dive into the nitty-gritty of mortgages, let's take a quick break.
Sounds good.
All right, welcome back.
Yes, welcome.
We just took a scenic tour of the economic landscape, but now it's time to get down to brass tacks.
Okay.
We've got a mortgage expert joining us who's been navigating these financial roads for years.
Nice.
They've seen it all from smooth sailing to those unexpected potholes.
We're excited to get your take on what's happened out there.
Yeah, thanks for having me.
On the front lines of the mortgage market.
Let's just say it's been an interesting ride lately.
To steer this conversation in the right direction.
Yeah.
From your experience working directly with people. What's the most important thing our listeners should keep in mind right now?
You know, I think the biggest thing is to just take a step back.
Okay.
From the headlines and all the noise about rising rates. It's easy to get swept up in the panic.
Yeah.
But we have to remember that rates are still relatively low, historically speaking.
It's true. Those super low rates during the pandemic really skewed our perception.
Exactly. And that's where a mortgage broker can really help.
Okay.
We can cut through all the clutter and find the path that makes the most sense for your specific situation.
Can you break that down a little further?
Sure.
How does a mortgage broker actually help someone navigate this kind of market?
Well, first off, we've got connections.
Okay.
We work with a ton of different lenders, the big banks, smaller institutions, even private lenders. It's like having a whole team of scouts looking for the best route for you, even if your financial terrain is a bit, shall we say, off-road.
So it's not as simple as just sticking with your usual bank or going with whoever has the catchiest jingle on the radio.
Not at all. Each lender has their own preferences and criteria, their own idea of what a good driver looks like, so to speak. What works for one person might not work for another.
That makes a lot of sense.
Yeah.
Now let's talk about this whole fixed versus variable rate dilemma.
Okay.
What are you advising your clients these days?
Honestly, there's no one-size-fits-all answer.
Right.
It really boils down to the individual's needs and how much risk they're willing to take on.
Right.
For someone who prioritizes a smooth, predictable ride, A fixed rate is probably the way to go. But if you're a bit more adventurous and want to potentially save some money down the road, a variable rate could be a good option.
And, of course, we have those variations on variable rates, VRMs and RMs.
Yeah.
It's like choosing between different suspension systems for your financial vehicle.
Right. With a VRM, your monthly payment stays the same.
Okay.
But the portion going towards interest can shift. So you might be paying off that loan for a bit longer than you anticipated.
With an ARM, your payments fluctuate with the interest rate.
Yeah.
So you better have good shock absorbers.
So VRMs offer some predictability with payments.
Yeah.
But ARMs have the potential for lower overall costs if rates drop.
Exactly.
It's about weighing your priorities and comfort level.
Right.
That's why having a conversation with a mortgage broker can be so valuable. We can walk you through all the options, make sure you understand the terrain, and help you choose the right vehicle for your journey.
Speaking of navigating tricky terrain, we discussed payment shock earlier.
Yeah.
Those sudden increases in mortgage payments, that can really catch people off guard.
Yeah.
Are you seeing that play out with your clients?
Oh, absolutely.
Really?
I'm working with a lot of people who are coming up for renewal and are getting sticker shock when they see how much their payments could jump.
What are you telling them?
Yeah.
How do you help them navigate that?
The first thing is to help them understand why this is happening.
Oh, okay.
A lot of people don't realize those pandemic rates were like finding a secret shortcut. They weren't going to last forever.
Right.
Rates are simply returning to a more normal route.
So it's about recalibrating their expectations.
Exactly. And then we explore their options.
Okay.
Sometimes switching to a fixed rate provides a sense of security.
Right.
Other times we might look at extending the amortization to smooth out those monthly payments.
You mentioned extending the amortization.
Yeah.
That's a term our sources mentioned as well. For those who might be new to this.
Yeah.
Could you explain what that means?
Sure. Think of amortization as the length of your road trip.
Okay.
How long it takes to reach your destination.
Yeah.
Which is a fully paid off mortgage.
Right.
A longer amortization means smaller payments each month. But you're on the road longer.
Yeah.
So you end up paying more for gas in the long run.
So it's a trade-off.
Right.
Shorter trip, higher cost per day.
Yeah.
Or a longer trip, but you save a bit on those daily expenses.
Exactly. It's not a decision to make lightly.
Right.
You need to carefully consider your overall financial plan and make sure the route aligns with your destination.
Now let's move on to some of the finer points of getting a mortgage.
Okay.
Our sources highlighted things like credit scores, down payments, and the stress test.
Right.
How are these factors affecting your clients in this current market?
Well, your credit score is like your driver's license.
Okay.
It tells lenders how responsible you are behind the wheel of your finances. It affects the interest rate you qualify for.
Right.
Like a good driving record can get you lower insurance premiums.
And what about down payments?
Yeah.
Are you noticing any changes in what lenders are requiring?
Not really. The minimum down payment requirements are still the same. But the size of your down payment can impact your interest rate. A larger down payment is like having a more reliable vehicle.
Right.
Lenders see you as less risky and are more willing to offer you a better deal.
And what about the stress test?
Yeah.
That's been a hot topic lately.
Right. Think of the stress test as a safety inspection.
Okay.
Lenders want to make sure your vehicle, your finances, can handle some bumps in the road.
Right.
Like those potential interest rate increases we talked about.
So even though rates have dipped recently,
Yeah.
the stress test is still in place.
Yes, it's still a factor, and it's important to account for it. When calculating how much of a mortgage you can realistically handle, you don't want to end up with a vehicle that's too big for you to control.
This is incredibly helpful.
Yeah.
Now, I'm curious.
Yeah.
Are there any common misconceptions or myths you're hearing from people that you'd like to debunk?
Oh, there are a few.
Okay.
One of the biggest is that you need a perfect credit score to get a mortgage.
Is that true?
Not at all. A good credit score definitely opens more doors and can get you better rates.
Right.
But there are lenders out there who specialize in working with people who have a few dings on their credit history.
Right.
It's like finding a mechanic who can fix up a car that's seen a few miles.
That's good to know.
Yeah.
Any other myths you want to bust?
And another one I hear all the time is that you absolutely need a 20% down payment to buy a home.
Ah, yes. The infamous 20% down payment.
Right.
It can feel like a massive roadblock
Exactly.
to a lot of people.
While a 20% down payment does help you avoid something called mortgage default insurance, which adds to your overall cost.
Right. There are programs that let you buy with as little as 5% down.
Okay.
It's like finding a more fuel-efficient vehicle that lets you get on the road without breaking the bank.
And what about the idea that you should always go with the big banks for a mortgage?
That's another one I like to challenge.
Okay.
Smaller lenders and mortgage finance companies can often offer better rates and more flexible terms.
Interesting.
It's like choosing a local independent garage over a big dealership.
Yeah.
Sometimes you get more personalized service and a better deal.
This is all so valuable.
Yeah.
But I know we're running short on time.
Okay.
Do you have any final words of wisdom for those navigating the mortgage market right now?
Don't be afraid to ask questions.
Right.
The mortgage process can seem daunting.
Yeah.
But it doesn't have to be. A good mortgage broker will be your co-pilot.
Okay.
They'll explain everything clearly.
Right.
Break down the jargon.
Yeah.
And make sure you understand all your options. That's excellent advice.
Yeah.
And with that, we want to thank you so much for joining us today and sharing your expertise.
It's been my pleasure.
For our listeners,
Yeah.
we've just scratched the surface of this complex topic.
Right.
We encourage you to keep exploring and learning more.
Absolutely. Remember, knowledge is power.
Yes.
Especially when it comes to your finances.
Now, before we conclude this deep dive,
Okay.
we want to leave you with one final thought-provoking question.
Ooh, I love a good cliffhanger. What is it?
We've discussed how the Bank of Canada's rate cut and asset purchases are intended to stimulate the economy. But what if these measures don't have the desired effect?
That's a great question.
Yeah.
What if the engine sputters instead of revs up?
Right.
What other tools does the Bank of Canada have in its toolbox?
It seems we have another deep dive on our hands.
I'm already intrigued, but we'll have to save that exploration for another episode.
Indeed. For now, we hope this deep dive has given you the tools and knowledge to navigate the current mortgage landscape.
And as always, we encourage you to keep learning.
Yes.
Stay informed and make financial decisions that align with your own personal goals.
Thanks for joining us on the deep dive.
Yeah.
We'll see you next time for another exciting journey of knowledge and insights.
Until then, keep those engines running and stay curious.